Good evening, everyone. A very warm good evening to all of you. So let's wait for a couple of minutes. Let's wait so that others can join as well, and then we'll start. Send me your email ID, TB. Send me your registered email ID. I'll ask the team to get in touch with you. So Priyansh, TB was facing some issues regarding his LMS portal. So that's why I asked him to share his email ID. Probably this week or by next week, will we will wrap up with your sessions, TB. We were left with discussing last few things regarding derivatives. So first, we will be giving our concluding remarks on derivatives, and without wasting much time, we will be starting with our session on fixed income securities. Okay. So Priyansh, about that, you will be having exams, but it will be scheduled once all the live lectures are done. Once you are done with all the live lectures. Okay. Those who have raised hand, SG Shivam, please let me know what is your problem. No problem. Okay. Fair enough, Swapnil. If you have any doubt, let me know. Yes, Shivam, please let me know what is your doubt about. For that, that is batch specific question, Shivam. Please raise a ticket about that, and you will be replied on ticket about the topics that has been completed. Because we have some merged batches, it would unnecessarily be creating confusions in the class. Okay. Now, yes, yes, Bhubalan ji, please let me know if you have any doubt. So it's around 5 months of curriculum, Shruti. So 5 to 6 months of curriculum approx, around 6 months of curriculum. So you can calculate based on that. But since this is no derivatives, we are in the last part of derivatives. We need to discuss just one small thing about derivatives, and then we will be done with respect to derivatives. Okay. So we have to discuss something called as American style option. Yes, derivatives notes have been uploaded on the LMS. We have American style options. So if you are not able to find it, make sure you raise a ticket about it. So I'm not the person because I don't have access to the LMS, to be very honest. So I'm not the person who can help you with whether the PDF issue is resolved or not. So just make sure if it is not resolved, you get in touch with the team and get it resolved as soon as possible. And if you are facing any challenges, let me know so that I can also escalate the issue from my end. So there is American style option and then there is European style option. American style options are those options that can be exercised anytime before the maturity, anytime before the maturity or at maturity. Whereas European style options, no, you didn't miss anything. We are just concluding our discussion on options. So yeah, don't worry guys, those who have joined a bit late, you have not missed anything, but make sure you join on time from the next time onwards. The exam will be concluded once you are done with all the live lectures. That is around 6 months of curriculum. Also, we are discussing about American style options and European style options. There are two types of options. One is American style option and other one is European style option. Now, what is American style option? American style option is basically a option which gives you a right to exercise the option anytime before the maturity. On the other hand, European style options are those options that can only be exercised at maturity. That is foreign exchange market. That is related to currency. So if you want to deal in currency, if you want to bet on whether US dollars will be appreciating or depreciating, then forex market is something that will be used. Okay. Now India basically has European style options. It means that if you are buying an option in India, it can only be exercised at maturity. Now, we have learned derivatives till now. I will give you some scenarios and you will have to tell me that how can we, uh, what derivative position shall we take so that we can hedge ourselves from those risks. Okay. Let's suppose you have holding a portfolio of equity. First of all, what is the risk associated to this portfolio? What is the risk associated to this portfolio? Let's suppose you are holding a portfolio of equity securities. What is the risk associated to this portfolio? Share price going down. Share price is going down. My question is, how will you hedge this risk using derivatives? What position will you take using derivatives to hedge this risk? Anyone? What derivative position you would take to hedge this? Very good. So first of all, you can sell futures, correct? Or you can buy put option. Buying put option. So put option bought in order to protect yourself from falling share prices. The strategy is called protective put position. Why protective put? This strategy is called protective put position. That is, you are buying put position to hedge yourself from falling market, falling share prices of the given security. So this is called a protective put position. This put is protecting your portfolio value to fall drastically down. That is protective put position for you. Everyone clear with this? Everyone? That is something different, PK. Second, let's suppose I am owning an underlying asset, owning shares of Tata Steel. I am owning shares of Tata Steel. Let's say the current market price of Tata Steel is 180 rupees. So what I would do is I will sell a call option. I will sell a call option with a strike price of 200, so that if the share price goes above 200, I am benefit from underlying asset. And if share price remains below 200 till maturity, what will I earn? Put seller earns call premium. Sorry, call seller earns call premium. So if the share price is below 200, I will earn call premium. And if the share price goes above 200, I will earn from the underlying asset. This strategy is called covered call. Okay. On the other hand, what I can do, if I feel, okay, RT, let's suppose Ravi that you are holding, let's suppose Ravi that you are holding a share of Reliance at rupees 22,900. What are you afraid of, Ravi? What are you afraid of? Share price going down. So in order to protect yourself, you took a put option, right? In that case, you benefited. Now this time, you are holding 2,900, one share worth 2,900 of underlying asset, that is Reliance. In order to make the best out of these Reliance shares, what you did, you sold a call premium. You sold a call option. And when you sold a call option, let's say with a premium of 200 rupees at a strike price of 3,000, what would happen when when the when the current market price is above 3,000, you are or even 2,900, you are benefiting from the underlying security. You are making a profit in Reliance shares. And if the price of these Reliance shares does not go above 3,000, if the price of these Reliance shares does not go above 3,000, this option, this call option will lapse out of the money. This would be the out of the money call option for you. And since this is the out of the money call option, 200 rupees is the premium that you will earn. Call option is for buyers. No, all as we discussed this in the last class, even call option has two positions. Call can be bought or call can be sold. Similarly, put option has two position. Put can be bought or put can be sold. So I think you are getting confused. Ravi, make sure that you are in touch with the subject, because It's everything is built in the last class. So make sure guys that while going to the next module, you don't forget what has been covered in the previous classes. Actually, call option is for buyers. No, call option is for those people who wish to be long on the asset, who wish to be long on the asset. So call plus position will make you will be benefited from a call position in case asset prices rises, asset prices goes up. So if asset prices goes up over here, since you are holding the underlying asset, you will be benefited. But you are also afraid that what if my asset prices does not go up? What if my asset prices does not go up? So what you would do, you would sell a call option with premium of 200 rupees, and if the prices does not go above 3000, that is the strike price, 200 rupees is what you will earn even though the asset prices does not go up. So this is how you hedge your portfolio. This is how you generate a stable income source from by using derivatives and underlying asset together. Now if you feel that market is going to go sideways in the coming time, if you feel that market is going to consolidate in the coming time, what you would do, you would sell both call option and put options, both call options and put options. So yes, as an investor, you can choose what option you want. So if you feel that market is going to consolidate, it means that option premium comes from two sources. What are those two sources? Option premium come from two sources. What are those two sources? First is intrinsic value, other one is time value. If you feel that market is not going to show a very sudden movement, either on upside or in downside, what you will do, you will sell both call and put options. So you will be enjoying call premium from call option, put premium from put option. And how will you be benefited? Because intrinsic value is not going to change since the market is in consolidation. Although it is going to change, there would be a very limited extent to which it would change. But the time value, as the time will pass with the movement of the share price being consolidated, the time value will fall. And who is going to enjoy that falling premium? That falling premium is something that benefits the call and put seller, or also the option writers. Yes, Shivam, please tell me, how can I help you? Shivam, please let me know, how can I help you? Yes, the strategy is straddle. Although this is something related to derivatives and mostly used in trading, it can also be used to hedge your portfolios. Okay. So what happens in a put option? I'll tell you. So Shivam is somewhat confused in. Yes, yes, I'm repeating again. If you are not understanding both of the operations together, think one by one. Let's say, let's say 4,700 is the price, 47,000 is the price of, is the strike price of call option. 47,000 is the strike price of call option. This call option has 1 week to maturity. This call option has 1 week to maturity. And current market price is 46,500. 46,500. Option premium option premium is, let's say, 450 rupees. It means that you have 1 week left till maturity. And you are expecting that in 1 week, the market won't show a very sharp up move or a very sharp down move. So what would happen? You feel, what according to you, you feel is, let's say after 1 week, you feel that maximum the market can go is 46,650. So if the price at maturity is 46,650, what would be the premium? What would be the premium of call option at maturity? What would be the call premium at maturity? At maturity, the call premium would be, after 1 week, this is the current market price. Strike price is 47,000. The call premium would be 0, because it won't have any intrinsic value. And since the option is matured, it won't have any time value as well. No intrinsic value and no time value, because strike price is 47,000. So 450 rupees is the loss to call seller. Sorry, 450 rupees is the loss to call buyer. And loss to call buyer is what? Profit to call seller. Loss to call buyer is profit to call seller. It means that this 450 rupees is made by the call seller. Why? Because the market was consolidating below the strike price. The market was consolidating below the strike price. Similar such strategy is iron condor. The fourth strategy that we are evaluating is iron condor. It's just that in this strategy, a great extent of OTM options are sold. Now, what is the great extent of OTM options? Let's say if market is 43,000 as of now, and still there is only 1 week left, there are slim chances that the market would cross 49,000. There are slim chances that the market would cross 49,000. So what I would do, I would sell call options. Slim chances means low chances. Then I would sell call options at strike price of 49,000. I would sell call options at strike price of 49,000. It would be available at a very cheap rate. Let's say it would be available at 80 rupees or 90 rupees. So I will be continuing this position for 1 week and earning 80 or 90 rupees premium in this. This strategy is called iron condor. Where we are selling a option with a high or a very high negative intrinsic value. So in this case, options which have been sold have a negative intrinsic value, so that the chances of options getting lapsed is higher. When will option get lapsed? When there would be a higher intrinsic value or a lower intrinsic value? When the option would get lapsed, when there would be a higher intrinsic value or a lower intrinsic value. If the intrinsic value are negative, the chances of option getting lapsed is higher. Why? Because if intrinsic value is positive or higher, it would be exercised by the buyer. Would you want the option to be exercised by the buyer, or would you want the option to be lapsed? As a seller of the option, you would always want option to be lapsed. Seller of the options always wish option to be lapsed because they want to earn premium. Option premium is the amount that seller earns and buyer loses. Intrinsic value is what buyer earns and seller has to pay. Okay, so that was all about derivatives, guys. With this, take couple of minutes and think about what all things we have covered in derivatives. Yes, Shivam, please let me know your doubt. Yes, Shivam, please. I'm waiting for you. Please let me know about your doubt. RK, I'm really sorry, but I have never used that software before. And I am not into trading, to be very honest. This was just a concept that helps to remember. So I won't be the I won't be able to explain that you on the trading software that you're talking about. So Shivam, it's your responsibility, right? That if you have missed those lectures, uh, you need to. Yes, yes, I'll explain that again. Mostly these strategies are used if you are using underlying asset with derivatives. If you are using underlying asset with derivatives, it is for hedging purpose. Like we saw, covered call and protective put. But in case when you are using derivatives and derivatives together to generate a source of income, it is obviously for a short term because derivative securities has maturity, and that is something that is involved in trading part. Although, so what I'm saying, what I said over there is premium is what seller receives. Premium is what seller receives. So premium is the maximum profit for seller. Option, I'm talking about option sellers. Premium is the maximum profit for seller. But in case of what seller pays, here we are evaluating what seller receives. But in case of what seller pays, it would be the intrinsic value. So if call option has a strike price of 1000 and current market price at maturity is 1300, the intrinsic value of this option, that is 300 rupees, is what sellers need to pay to the buyer, and this is what buyer's profit is. This is what buyer's profit is. Okay, this is what we were evaluating. So PG, the PDF file had been shared to you. If it is not available in the chat box, guys, please make sure that you go through the LMS, and if you don't find the sheet, raise a ticket about it. I think all the sheets related to economics might have been already been uploaded. Okay. So someone is having doubt in iron condor. Although what I can do in to explain iron condor is, let me just give me a second. Let me just share my screen, and I will open Grow app, which is the which is my broker, which is the discount broker that I use. And using that, I will try to explain you what iron condor actually is. Just give me a second. Yes, because I'm entering my login details. I can't share my login details with whole class, right? So just let me log into the screen with my respective ID and password, and then I will share my screen. Okay. Okay. So you can see this is Bank Nifty, that is Nifty Bank, and Nifty Bank is has last closing price of 49,803. Okay. So this is 49,803.20. There are various strike prices associated with Nifty Bank. And if you evaluate, this is 49,803. And if I go to the option chain, where we are evaluating options for 12th June, that is coming expiry, which is due in next week, and evaluating call options, you will see that all the, as we go from 49,800, 51,000, and 52,000, I don't know how this is not in an ascending order with respect to strike price. I think this is with respect to open interest. No, that is not open interest. I think this is associated with volume. So they have arranged it in volume. Let's try to go to option change. Please tell me in short. I want to know how election news affects stock market. Okay, I will come to that as well. Don't worry. So see, these are my call options for 12th June. These are my call options for 12th June. And as you see, as I am going more above the strike price, as I keep on increasing my strike price from 49,900, 50,000, 50,100, 50,600, 51,100. So what would happen? My option premiums are falling. Why they are falling? Because I am going out of the money in case of options, in case of call options, correct? Rohan, are you trading by any chance? Are you into trading? Sorry, Rohit, right? RK, are you into trading? So this is call options, and as I'm going down, 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 you will see call premiums are falling, but put premiums are rising, because in case of put option, I am going more in the money, right? And in case of call option, when I am going down, I am going out of the money. On the reverse end, if I am going up in the strike price, that is from 49,800 to 49,700, 600, you will see the premiums of put might be falling, because all these put options are out of the money. All these put options here, when we are going up, we are going OTM in put options. So what we do in Iron Condor is, okay, I'll tell you what we actually do. 49,800 is the strike, is the current market price. What do you think can the maximum movement that the market can make in next 4 days, next 4 trading days? That is the expiry is on 12th June. So 10th June, 11th June, 13th June, and 14th June, 10th, 11th, 12th. So 3 days, 10th, 11th, and 12th. What is the maximum deviation that the market can make in the next 3 trading sessions? In case of Nifty Bank, what do you think? What is the maximum deviation that the market can make? 1,000 point. GV is saying 1,000 point. GA can saying GA is saying 2% up or down. Please say that in point terms. I consider 1,000 points up or down. Ankit Thakur is saying 50,100 is the max market can go. Anyone? Any more responses? Rohit, you want to try to get a gauge? What are you expecting out of the market from Bank Nifty? KV is saying 1,000 points up. So currently the market is around 49,800, and all of you are saying that it may maximum go 1,000 points up or 1,000 point down. So 1,000, 49,800 plus 1,000 point would be 50,800. So you are expecting that market won't go above 50,800, correct? Okay, RK. So you might be following Iron Condor way. I'm very sure about it, RK. So you might be doing this in case you are selling options. So maximum, if you feel that market won't go above 50,800, what you are doing is you are selling a call option worth at a strike price of 50,900. And when you sell a call option of 50,900, 144.85 is the premium that the seller receives. And if the market won't go beyond 50,900, don't you think this 50,000, this will soak up all the time value, that is 144.85 is the time value of the option, And when this option matures, the option will have zero time value. And since the option will have 0 point time value, okay, RK, very good. So RK, I would be very glad to learn from you all those strategies that would help me to share to the class as well. So if you are free between Monday to Friday, any day, we can have a session together. We can discuss about the strategies and how it could actually be implemented. Since I am not more into in trading, I am more into investments, and that's why I am requesting you to volunteer for the class. Okay, so it's 50,900. And if the time value, if the option, if the strike price of the option won't go beyond 50,900, the value of the option will become zero. If the time value, if the option won't go beyond 50,900, the value of the options can go beyond zero. Now, if the value of the options goes beyond zero, 144.85 is the premium, that is the premium that the seller gets, is the ultimate profit that he makes. That is iron condor. You are taking similar position in case of put option as well. So as you said, market can go 1,000 points up or 1,000 point down. So 1,000 point down is 48,800. You are expecting that market won't fall below 48,800. So you will sell put options worth 48,800. So it is 128.50, and the market does not go beyond 48,700, does not go low beyond 48,700. Since this is an OTM option, this is the profit that you are going to make, 128.50. Am I correct, RK, over here? Please correct me if I'm wrong. Since RK is into trading, we would be happy to learn from his experience. Okay, Shivam, tell me if you have any doubt. Please don't keep on raising hands. You can directly post the questions in the chat box. Your questions won't be ignored. So tell me, Shivam, what is the intrinsic value for put options? What is the intrinsic value for put options? How can you calculate intrinsic value for put options? Shivam, what is the intrinsic value? Leave this aside. Tell me what is the intrinsic value for put options? Strike price minus current market price or current market price minus strike price? Okay, tell me, Shivam, whether all these are ITM options or OTM options. No, that is not always the case. Sometimes these are OTM options, right? So these options, all these options that is over here, does it include only time value or time value plus intrinsic value? I will come to your doubts, Swapnil. Just give me a second. All these options has only time value or only intrinsic value. You yourself said, SG, this is OTM option, out of the money option. Since in the money option means they have intrinsic value, out of the money option has only time value. And if the time will pass, the option will lose its value. All the OTM options that is over here has only time value. OTM options does not have intrinsic value. The intrinsic value for OTM option is negative, and it's to the floor to zero. Okay. So all these intrinsic value, OTM options only has time value. And if it won't fall in case of put option, if the market won't fall beyond 48,700 or 48,800, the value will become zero. And if the value becomes zero, who will benefit? Whether the seller will benefit or the buyer will benefit. Let's say I sold you something worth rupees 150 and that value becomes zero. Who benefited? I benefited or you benefited from it? The seller will benefit, right? Similarly, seller is trying to benefit from this as well. In case of call option, if the market won't go beyond 50,800, here you have sold the options worth rupees 162, you will benefit. Since again, the option will remain unexercised and no index options can be exercised. That is altogether different thing. Now coming to doubt, one of the doubt, is the closing price of Friday is same as the opening price of Monday? No, that is not the case. Sometimes market open gap up or gap down. So if the closing price is 10,000, again open interest is something that is related to trading part. I think open interest are the number of contracts or lots that are actively being traded. So if let's suppose there are 22,768 or 22,208, I'm not sure about it. Again, I think I had read somewhere that 22,208 are the contracts that buyer had bought and seller has sold, and the positions are open as of now. These positions are active. These are active positions in the contract. That is carried forward position. It means that these positions had not been squared off in the last trading day. The buyers have carried forward this position to Monday, and sellers have also carried forward these 22,208 contracts till Monday. Correct, RK? On which behalf market get gap up and got gap down? Market gets gap up and gap down based on the news that is being followed in the market. So if there is a news which supports the market, which is a green light for the market, like uh, like it was on Monday, last Monday. Remember on last Sunday, I told you, I think tomorrow market would shoot up. And on Monday, market showed a good green rally. But on Tuesday, something happened in Indian markets which caused a gap down. And what are the factors due to which markets opened in green, and in the next day there was a sharp correction? We will come to that point as well. Just give me a minute. No need for every column in this chart, right, sir? It was showing the green sign and orange sign, which can be used for understanding the green sign in the money sign and out of the money sign. No, actually, that is not the case. You see, all these options are out of the money. Uh, all these options are these put options. These put options are in the money, and still they are in negative sign. These call options are out of the money, still they are in positive sign. So it's not always the case. The green sign represents the ITM options and the red sign represents the positives of OTM option. That is not the case. Who decides market should open in which way? To open on trading market, exit polls. Can you give example of exit polls? That would be political, but I will still get to it. Just give me a second. What and sold their positions the next day. So very sharp price and very sharp decline on opening bell. Basically big players. Okay, sir. Okay. So let's be back to our whiteboard and try to discuss what happened. So someone asked how political news influence market. How political news influence market. So there is existing government in power. That was NDA government in India. Markets always wants that existing government should remain in power for the trend to continue. Why? Markets always want that existing government remains in power for the trend to continue. Why? Because this government has came up with some policies. These policies may be related to infrastructure, may be related to consumer spendings, may be related to interest rates, or may be related to welfare schemes. Although this is a very broad parameter, but still I would try to summarize it with you, summarize it to you with an example. Let's say NDA was in power. BJP being one of the most crucial element of NDA, BJP being one of the most crucial element of NDA has some allegations that they are in good talks with Adani company, Adani Enterprises, or Adani group of companies. Since BJP is in touch with Adani group of companies, who will benefit when NDA is in power? Who will benefit when Adani group is in power? BJP will benefit, and if BJP is in power, who will benefit? Adani Group is benefit. So Adani, BJP has given Adani Group various projects, power project, port projects. I will come to that as well, Aslam. And various projects in various other infrastructure. Similar to Adani Group, there are different groups. There are different groups listed in stock market who are traded under Nifty 50, who are being traded under Nifty 50, like Reliance, like Tata, banks like HDFC Bank, Kotak, and other banks as well, SBI. These are the companies that are part of Indian stock market, and the price that they are reflecting is based on policies that sitting government has made, or the government that is in the power has made, or existing government has made. The price, yes, Maruti Suzuki. So the price basically that all these stocks are showing is based on the policies of existing government. There are 50 companies, guys. We can't just list on every company in the Nifty 50 index. So these prices are based on existing policies. And any news that confirms the belief that existing government will be in power will help this company to grow more. Will help this company to grow more, and not only grow more, but show stable performance in future as well. It will help them to grow more and show stable performance in future as well. If existing political party is back in power. Exit polls. Yes, please ask your question in the chat box itself. Exit polls suggested that the government or the ruling party will be coming back with a better majority. And that majority was greater than 350 seats. And since they were expecting 350 seats, market was, and compared to market, Bank Nifty was 3% up, and Bank Nifty was around 3.5% up. That is around 2000 points up on Monday trading session. If you remember in the last slides, I told you that I expect that tomorrow market may shoot up. And the reason why I told that is because exit polls were favoring ruling party. But what happened the next day was something very strange. The NDA alliance closed at 292 seats. The NDA alliance closed at 292 seats. So market had priced itself at 350 plus majority, but the early signs of the vote count showed that it would be very difficult for the market to come across 350 seats. And that is why market went through a sharp fall on that day. That was around 4,000 points in Bank Nifty. It went down till 5,500 points, but ultimately recovered. And it was also seen, since ruling party or one of the major component of NDA, that is BJP, was not able to secure a full majority of 272 seats. It was also expected that BJP government could fall. It means that government can change. And if government would change, the policies would change. It would no longer be friendly to existing companies who benefited in the last market. It can be more favorable to them as well, but there was no surety. The policies that the new government would come up with was unstable. Yes, Bank Nifty comprises of Nifty banking stocks in Nifty. So Bank Nifty is different from Nifty 50. I don't think so, GV, that today on Monday market would shoot down. I will tell you why. I will probably it might shoot up, but I won't. I am not sure about it like I was sure about it in the last class. Yes, Sensex also tanked down to 4,000 on Tuesday because there was a possibility that the BJP led NDA government could go out of power and India Alliance could win the election. But this was due to two major parties, that was JDU and one party from Andhra Pradesh. The party was TDP, correct? JDU is led by a person called Nitish Kumar and TDP is led by Chandrababu Naidu. So when Nitish Kumar and Chandrababu Naidu confirmed that they are extending their support to Narendra Modi government, that is BJP-led government, there was a surety back in the market again that BJP won't go out of power and the existing government is not going to change. And when market found that existing government is not going to change, it has tried to recover itself in last 3 trading sessions. So you might have seen that last 3 trading sessions were signs of recovery for Indian stock market. So this was all the news about. Even what helped more for the stock market to be stable was the fact that India Alliance agreed that they don't want to come in power as of now. They would try to be a strong opposition and a better opposition to the nation. Okay, so that was all about derivatives, politics, and how markets react to good new news. So if there is good news in the market, which is been in public domain, after the last closing sessions, the market can go gap up. The market can open gap up. Or otherwise, if it is a bad news, it can go gap down, since between the time when market closed at 3:30 and when it will open at 9:07, in case of India, I'm talking about, there was some news that was not incorporated in the market, and this gap up and gap down try to incorporate that news. Now there are various process associated to it, that why there is a gap down, because at 9:07 trades are placed and it has been executed at 9:15. So this gap up and gap down is determined by the trades or orders placed at 9:07. So all these things are has nothing to do with investment banking. Yes, GA, but again, digging deep into those factors, why BJP lost is not the motive of today's session, right? And we have our international students as well. So it's not appropriate to make our discussion India centric. Okay. So there we are done with derivatives. So yeah, so someone is asking, BS is asking that what about insider trading? Till what extent it can affect the Indian markets? Insider trading, so there are a huge population. There is a huge population in India, first of all, and very limited people are open to the news of insider trading. There are regulators who prohibits insider trading for a fair and healthy practices to be adopted by the market. But does that mean insider trading does not exist? Of course it does, but only few people are available with the insider trading. And again, trading is something that comes with a short-term returns and a high risk. So if you want to make consistent wealth, trading is something that you should avoid if you are not the kind of a person who loves risk. And it depends on various things. It depends on your willingness to take risk. It depends on your ability to take risk. And it's also about the psychology that you want to adapt for yourself. So in trading, there is something called as behavioral finance. That is, all those are different things. But talking about insider trading, every regulator in the world tries to prohibit it. So CB, that is actually a market, that is actually a black market, and I am not open to discuss on that part. That is Dabba trading. I think that is a market in Gujarat, and it has been practiced over there. That is one sort of black market in stocks or shares. So that is something very different from insider trading. Insider trading involves some people might have access to information that the majority does not, and based on that information, they are uh, running ahead of the crowd and trying to benefit from the trades using those information. So if there is an information cascade, what is information cascade? Some people might have access to information that the others might don't. For example, some people who might know that the government won't is not going to cross 350 seats for sure might have taken a put option a day before, and the put premium, which was 70 rupees till yesterday, or 7 might be 5, 10, 15, 20 rupees till yesterday, went up to 2,400, 500. So it's around 1250 times, sorry, 125 times in one single day. So all these factors contributes to insider trading, although it is not technically possible for everyone to do insider trading. Otherwise, the trading won't be called as insider trading if everyone has access to the information. I don't know again the location of that market. Doing trading is growth for economic, not trading, but actually investing in the capital markets is the growth for economy, because more individual or a nation as a citizen, we would contribute in capital markets of a nation. The more businesses would have capital, and the more businesses would have capital, the more they would invest in property, plants, and equipments. There would be more employment for a nation, and that would lead to a growth story of a nation. No worries, Arti. That is not something very GV. I think it is in Gujarat. I'm not very sure about it. That is something very that is some sort of a black market in India, which is run regarding securities and stocks. So Ravi, that is not something hard and fast rule that you need to be well aware about it. If you are interested, you can research more about it, but still there is no compulsion though. So gray market is an unlisted market where the buying and selling of shares that has not been listed yet takes place. So if you want, so some companies like Zomato might have issued ESOPs, employee stock option plans, and these ESOPs, once vested, once vested means once given to employees, they can sell in unlisted market. So if I want to be the owner of the market, I want to learn trading, how I can. There are various courses available for trading. Like this is an investment banking course. There might be different courses related to trading. So you can definitely try to research about it on your own. I won't comment a specific course for you, Shivam, because trading is again a very dark area, something that needs a well-versed expertise, and it is very much open to financial losses as well. There is a high probability of financial losses when you will go for trading. So make sure you make this decision on your own choice. Yes, it is very different, RT. So ESOPs are something that employee of a company get for being serving for the specific company. So let's suppose there is a company like Google or Zomato. You, as an employee to the company, have contributed to the growth of the company. You as an employee of the company has contributed to the growth of the company, and this growth of the company is reflected in the share price of the company. So management would want you to be a proportionate or partial owner of the company in order to align your interest with the company's interest. In order to align your interest with the company's interest, so you will work hard considering it your own company, and how you will be benefited, the shares that you are holding might have a higher price. Now there might be some companies like Zomato, which was not listed 3-4 months before today. So if the company is not listed, not everyone can buy those shares. But as an employee, if you wish to sell those shares, you need a buyer for it, right? So gray market is a place where the buyer of unlisted companies connects to the sellers of unlisted company and the trading takes place. Again, this is not part of the curriculum since some people were curious about it. So we felt a need to discuss this. Correct, KG? Are you comfortable with this? So we will be starting with fixed income securities. Lately. But before starting with this, if you guys want break, tell me here itself. So that, yes, RT, tell me what is your last doubt about. RT, tell me what is your last doubts about. Okay. We will coming to interest rate swap. That is one kind of swap in today's class. Although swap is an exchange for swap is a over-the-counter derivative, and a few things about swaps was also discussed in the last class while covering derivatives. Okay, so go on a break, guys, but be right back in 5 minutes. Okay, we discussed about swaps in the last class, that swaps are exchange traded contracts, and few things that is interest rate swap, that is something that we are going to cover today. Not today, but in fixed income securities, the module of fixed income securities. No, RT, it won't. There won't be all the concept that you will be tested on today. It would depend on which career path that you are choosing. So if you are choosing something related to derivatives, then you will be heavily tested on derivatives. If you are choosing something related to equity research, then financial modeling and DCF valuation is what you should focus on. If you are choosing something related to fixed income securities, then bonds and fixed income securities are something that you should go for. Yes, yes, you can choose your career path. So make sure you apply on those job roles that interests you. Yeah, swap is part of derivative, but I said there are few concepts of fixed income securities that needed to be covered to make you understand what is interest rate swap. That is a kind of swap derivative. So it has already been covered in derivative. I agree to you, but it would be covered in more detail in fixed income securities as well. So Nika into investment banking? I think Nika is not into investment banking. Nika is a fashion, is something that deals with women fashion accessories, right? Or I think they have also come up with their e-commerce again. So there might be an investment banking division in Nika that you can opt for in case they are looking for a financial analyst or a merger and acquisition analyst who would throw their expertise related to acquisitions in their space. So focus on the whole curriculum KM, that would benefit you. Yes, yes, bonds valuation will be covered over here. Yes, we are going to cover a whole module on investment banking. For few people, it had already been covered, and all those things you have investment banking in your curriculum as a different module. So all those things that will be covered over there. Yeah. So sure, VT, just raise a ticket about it, and I will share you the details. Make sure you raise some ticket about it. Raise a ticket about it. Okay. So guys, 3 minutes left to the break. Go on a break and be right back. Be right back in next 3 minutes so that we can start with fixed income securities. Still, there is a lot of time left, RT. Don't worry. Let the opportunity come to you. Don't be strangled to one opportunity. You have time to make some experiments. Try to start with your career, and then you will know that whether you are made for it or not. Then I will be there to help you, TV. So make sure you practice as much as you can so that you are able to match the balance sheet. I guess it is above 50. I'm not sure about it, PG, but I guess it is above 50. For that, Wasim, raise a ticket. I will share my list with you. I think what Zebra learns include is probably everything that we have covered in class. So you don't need to go for Zebra learn. Although there are some free PDFs available for that. If you just want to refer it, you can go for it. The free PDFs are available, I guess, on various other platforms. Yes, theory is the major portion of the interview, and with understanding theory, you should also make sure that you are able to explain it. Yes, Sikandar, please ask your doubt on the chat box itself. If you don't have degree from a top B school and you wish to enter in private equity, you need to have a good experience in the market and with lots of. So what a good degree will do is reduce your struggling years. So you will need to enter into a firm starting with an intern, and then with performing better and better each day by day, you can promote yourself in that particular association. What is the process of selection in investment banking? There are different processes. Some of the job roles might ask you to make a model. Some of you might give you a problem sheet that you are expected to solve. Some of them might call you for an interview. No, that is not must, TV. Guys, again, this is not a career guidance session. And please limit your doubts to something that is academic. For career guidance, you can raise a ticket and we can sit one-to-one. But still, it is not must, TB. What you can do is you can go through this course and try to watch what you like, and based on that you can make your own career. Try to apply for those jobs, and try to find that what are the opportunities that you are looking for, and if you are lacking a skill that that particular job role needs, you will be, you can accommodate skills through your journey. Okay. What is the process of selection in investment banking? As I said, there are different processes. Some might call you for the interview, some might ask you to make model or give projects, and some might also schedule a GD for you. So by practice is the only thing that you can do to make yourself perfect. Yes, Manish, it would be relatively make you stand out of the crowd. That is for sure, and you will eventually have an edge over your competitors applying for the same job role. So what are fixed income securities? Earlier, we saw there are various softwares like Bloomberg and Capital IQ, Screener, all those things. Each company, each investment bank uses their own software or own set of softwares. So you will be, you as if you are joining as a fresher, you are not expected to know everything beforehand, right? So you will be trained on the respective softwares that that particular investment bank or that or your department is eventually going to use. Coming to fixed income securities, we had saw equity securities. Does equity securities guarantees you return? Does when you invest in a company, does that company give you in writing that this is what you will be receiving over the years, over next 3 years, 4 years, or 5 years? How does it depend, Arti? Can you give me an example of any equity security that would give you absolute return or confirm return? So there is no guarantee, right, in equity securities. But when we talk about fixed income securities, my dear friends, fixed fixed income securities are those securities that comes with assurance. I will come to that as well, SG. Don't worry. Preference shares are those securities, although it is equity securities, but they are part of fixed income securities. Although preference shares sounds like equity securities, but preference shares are part of fixed income securities because your income is fixed in preference shares. You don't get something other than the assumed risk you have taken. Yeah, fixed deposit is a part of fixed income securities. So fixed income securities are those securities that gives you assurance or certainty about what? About returns. And how returns are generated? Returns are generated using cash flows. So the certainty is about what? The certainty is about amount and timing of the cash flows. So the securities that gives you assurance and certainty on returns is fixed income securities, and returns are generated through cash flows. And the securities like fixed income securities gives you the certainty on amount and timing of the cash flows. So bond is a example of fixed income security. We will see actually what bond is, but to be starting with, fixed income securities are generally debt securities. Although we will see what are the other types of fixed income securities as well. Bonds and debentures, yes. So what happens in a debt securities is you are giving capital to someone else, let's say a person A, A person A might invest it anywhere and generate some return for himself. And out of that return, he will give you the return. If he is successful enough, he can earn 100, he can earn 100 rupees and pass on 10 rupees to you. But even though he is not successful, even though he is at a loss of 100 rupees, still he is liable to pay you 10 rupees. So fixed income securities are those securities which comes with lower risk as compared to equity securities, but relatively stable returns, and hence they have a limit to their returns. So the returns expected from fixed income securities are also lower than equity securities. So everyone is clear till here? Now, the question is, how actually this fixed income security actually does function. Now, to understand that, let's try to understand bonds. What are bonds? How bonds actually function? What are various types of bonds? And let's take bonds as a representative of fixed income securities for a time being. So let's suppose I am corporate, I am Reliance Industries, and I want to raise capital. I have a very lucrative project in front of me, and I am sure that this project will give me a good return, but I don't have funds with me. I need capital. So how can I get that capital? How can I get the pool of funds? Yes, government also have bonds. That is correct. How can I create that pool of capital that I need to invest? So I will, there are two major sources of capital. One is equity, other is debt. So if I want to get equity, I will issue shares. I will come up with an IPO or an FPU. But when I need debt, I will come up with bonds. When I need debt, I will come up with bonds. How does bonds actually work? How does bonds actually work? So let's say as a part of such big corporate, I need 10,000 millions. And it is difficult and highly risky for one single entity to fund me 10,000 million. So what I could do is I could raise, I could raise it from various different investors. I could raise it from common people like retail investors, each would contributing me 1 lakh rupees so that I can get a pool of 10,000 million. I could raise it from mutual fund houses who are managing people's money. I could raise it from asset management companies, or else I could also raise it from some hedge funds. Now, when I am taking debt from all these people, basically I am taking a loan. When I am taking a loan from all these people, I should give them something in return. That let's suppose I and RT, I and Ravi have entered into a contract where I will be taking, I am coming to what is hedge funds. Hedge funds is basically mutual funds for high and ultra high net worth individual. Basically, hedge funds are nothing but mutual funds with high risk and also high returns. Okay. Now, if I want to take loan from all these individuals, I will have to give something in return. So what I give them in return is bonds. What I give them in return is bonds. What are bonds? Bonds are contracts or financial instruments that helps corporates to raise funds through debt. Bonds are financial instruments that helps corporates and institutions to raise funds through debt. Coming to the next thing, practically, no, hedge fund is not, we have skipped derivatives now. We are no longer the part of derivatives. We have come to fixed income securities. Not everything that is highly risky. Hedge funds use derivatives. That is true. But hedge funds is not the part of derivatives. Hedge fund use derivatives. So if hedge fund is basically nothing but replace hedge fund with portfolio management companies. Don't get confused yourself. Replace hedge funds with portfolio management companies, PMCs. Okay. So they will be collecting money from the top 1% of the nation and managing their funds. Okay. That is hedge fund basically. Now, I am giving bonds and taking debt from my investors, and these investors are debt investors. I am giving bonds and taking debt. What would these bonds do? These bonds are nothing but basically contracts that would have clearly mentioned that what is the amount of debt I have taken, what I am expected to pay back, what time, at what time I will be paying paying back the interest, at what intervals, at what intervals am I going to pay the interest. Basically, at what intervals am I going to pay the interest means whether I am going to pay monthly interest, quarterly, coming to that is next thing, semi-annual and annual. Next thing that would be mentioned is when I will be returning the principal. So when we give debt, we expect the interest to come in the interval terms, maybe annual, semi-annual, monthly, or quarterly. But we also expect our principal to come back as well, right? When does the Reliance is going to pay me back my principal? When is return of principal being promised? Okay. So all these things will be mentioned in a bond. This was from a theoretical point of view, so that you can understand what actually bond is. But practically how bond does work, we will see that. But are you guys clear with this part? Everything that we have discussed over here, basically debt securities, maturity, intervals, all these points. Are you comfortable with this? One thing. Okay. Okay. Intervals basically SK is the time period at what interval the interest is being paid. So let's suppose you have given me 1 lakh rupees and I have promised you to pay 10% interest. What I can do is pay you 10,000 interest every year, but once a year. What I can do to you is pay 2,500 interest every 4 months. Or else what I could do is pay 10,000 divide by 12, whatever the amounts comes every month. So this is interval. Whether I am paying you back interest every month, every quarter, every year, or every week, or every day. That is interval basically. Now there is a difference between pricing and valuation. Pricing is something that is fixed. Valuation is subjective in nature. What do I mean by this? If I want to buy Reliance shares, I and the rest of 150 crores of Indian and rest 7 billion people on earth, all these would be priced the same amount for Reliance shares. What I'm trying to say is prices are same for everyone. Let's say if I, KV, SK, GV, GA, everyone goes to buy Reliance shares, will every one of us get their shares at different prices? No, right? Every one of us will have the same price. Every one of us will have the same price for Reliance shares. Correct? So prices is same for everyone. Then what is valuation? Valuation is the art of finding out the right price. And my dear friends, right and wrong are subjective terms. Something might be right for you, that thing might be wrong for me. Something might be wrong for me, that thing might be right for you. So what is valuation? What is valuation is coming from a term that is intrinsic value. Valuation is the process of finding intrinsic value. And what is intrinsic value? Should be price, or according to my analysis, right price for a given security. Now this right price or should be price, I feel the price should be 500. You feel the price should be 800. Someone else feels price should be 900. The second person feels price should be 100. So this should be price and value is different for all. So my friends, my dear friends, equity securities are valued. Valued means we are trying to find the right price of that security. No one knows what exactly the right price is. But fixed income securities are priced. In case of fixed income, price is equal to value. What should be price is the what actual price is in the market. But in case of equity securities, I feel the price should be 500, but equity security can be trading at 400. So the prices and value are different things. So can I say fixed income securities have fixed prices? That is why the name coming as fixed income securities, because all these securities have fixed prices. Everyone clear with this? Everyone clear with this? Now, now, all the clauses, all the clauses, or so Naveen, basically what I am saying, since fixed income securities fixed income securities is called fixed income securities because they don't have different values for everyone like case of equity securities. What I am trying to say is, let's say if I trying to fight, I will come to that. Just give me a second. Okay, let me cover this clauses part again sometime later. But what I'm trying to say is just one single thing, a very simple thing is that if I try to find value of fixed income securities or any other person in the world try to find it, all of them, all of them will be using the same formula because the prices are fixed. Through this particular formula, the process is fixed. To get to these prices, the process is fixed to get to these prices, and the formula is fixed to get to these prices. That is why everyone who is trying to value fixed income security would get the same price. And that is why we do pricing of fixed income securities. But on the other hand, while evaluating a equity security, there are various different formula or various different methodology that you can accept, like dividend discount model, free cash flow model, residual income model, or relative valuation model. So for equity securities, everyone might get different values, but for fixed income securities, value is fixed and that value is nothing but the price of the security. Okay, everyone clear? Naveen, are you clear with this? Naveen, GA, are you clear with this? GA, shall I go ahead? Now, all the clauses or conditions mentioned, I will come to that. We will see how, what are values and how we are valuing fixed income and pricing fixed income securities. I will come to that in this. So we have a lot to cover on that part. All the clauses and conditions, basically terms and conditions mentioned in the contract, that is bonds, representative of fixed income security, is called indenture. So indenture is a document on which all the clauses and terms and conditions are mentioned. What are the terms and conditions? What would be the amount that I am going to raise? What will be the interest that I will pay? When will be the interest I will pay? At what interval am I going to pay the interest, and at what time I am going to return the principal? All these are the questions that has been clearly mentioned in the indenture. Okay. Now coming to terminologies of bonds. Moving to your doubt, NS, where you asked me about valuation. To understand valuation, this is the foremost part of the valuation, the most important part of the valuation. To come to terminologies, there are few terms that you need to understand. First is face value. First is face value. This is the amount the issuer pays to the investor, pays to the investor at maturity. This is the amount the issuer pays to the investor at maturity. When Reliance is issuing shares, whether Reliance is issuer or whether Reliance is investor. Yes, this is under bonds. when Reliance is issuing the shares, whether Reliance is investors or whether he is issuer. Very clear, guys. Be very clear with this. Reliance is issuer. Very good. And the one who is investing in those securities, who is buying those bonds, are investors like retail investors. Let's say people like you and me. So clear with face value. Clear with face value. Second is coupon. Coupon payment. Coupon payment is nothing but, let's say face value is 1000. So when the bond will mature, Reliance will pay you back 1000. Okay. Let's say I've been coming to that cable. Just give me some time. I've been coming to examples as well. Let us not just be confused. I'm definitely sure you are going to understand everything, but let me just complete at least. Okay. Coupon payment, periodic interest, not interest actually. You can think of it as an interest on your in your own mind, but I won't call it interest. You can think of it interest in your own mind, but periodic payments paid by issuer to investor. Periodic payments paid by issuer to investor. This is your coupon payment. And formula for coupon payment is coupon rate into face value. Remember this formula, very important. Coupon rate into face value. Third, I will tell you why I don't call it interest. Yes, you can call it FV into CR. Third, coupon frequency. Whether you will be receiving coupon once in a year, twice in a year, thrice in a year, or every month. So if you are receiving coupon once in a year, it would be annual coupon frequency. The coupon frequency would be annual. What if you are receiving coupon payments twice in a year? If you are receiving coupon payments 2 times in a year, it would be semi-annual. 4 times in a year. Yes, BS, I will refer it that way, but give me some time. 4 times in a year, quarterly. And 12 times in a year, monthly. So these are the possible coupon frequencies. These are the possible coupon frequency 1, 2, 4, 12. Clear? Everyone clear till here? Fourth point, 6. You cannot receive coupon every twice a month, right? So the coupon frequency would be 6 times, but there is no some terms associated to it. So if you are receiving 6 times coupon, you are receiving coupon twice a month, but that is not common with every bond. That is very rare. So there is no terms associated to it, but you can call the coupon frequency 6 times. Fourth one is time to maturity. Time to maturity, number of years remaining for the bond to get matured. Number of years remaining for the bond to get matured. And finally, YTM, yield or return to maturity. That means if you hold the bonds till the bond gets matured, what is the return that you are going to make? This is yield to maturity. Yield is nothing but return. Remember, this is return you are going to make if you hold the bond till maturity. Now take couple of minutes, try to understand each and every term. In fact, take 5 minutes, it's completely fine with me. Try to understand each and every term. Over here, all the 5 terms, try to be crystal clear with this so that we can move ahead with the example of this. I will come what are treasury bills, what all those things comes under. We will come to different types of fixed income securities as well. Yield to maturity is nothing but returns that, so let's suppose AP, you are holding a bond. Yes, bonds are transferable. Bonds are transferable, yes. And what you mean by transferable is tradable. Yes, bonds are tradable. Bonds are traded. What is the difference between coupon payment and yield to maturity? Okay, this is one question, one genuine question that I have got. Yes, all the bonds are tradable. We can't call it stock market. It is debt market basically. But yeah, it has been traded in the exchange. You can buy bonds as well through an exchange. What is coupon payment? What is difference between, right? Yes, RK, but that is something we will come to in cash equities. So that is not the part of, basically think of money market is the market for trading short-term securities. We will come to money market as well. Have some patience. We will come it in the next class. But let's just stick to bond for now. What is difference between not money market? See, difference between coupon payments and yes, FII can also buy bonds in India. That is true. We cannot we can pledge these securities. It's not about lending the bond. We can sell these bonds to others. So if I have purchased the bond, I can sell this bond to you. And how these bonds will be sold, that is also something we will see. What is difference between coupon payments and yield till maturity? What is difference between coupon payments and yield till maturity? Everyone clear with this? This was one genuine question that I felt. Any other doubts other than this based on these 5 concepts? This question will be answered through the example. When we will see example, we will see what is the difference between coupon payments and yield till maturity. But apart from this, PK, have you asked anything? Is the calculate yield to maturity? Yes, there is a formula. There is a formula to calculate yield to maturity, but that is not something. What is periodic payment? Periodic payment is nothing but coupon payment. Periodic payment is the payment that is released after every period. Paid after every period. Yes, you can do that. I think so. Although I have never tried it, but yes, you can do that. Coupon rate into face value is coupon payment. It means that periodic payment that I am going to pay to the investors. Okay. Period in terms of years. Period. These were the period. Period in terms of whether it may be annual, semi-annual, quarterly, monthly. So coupon payment is if the if if the coupon frequency is annual, you will be paying annual interests. If the coupon frequency is semi-annual, you will be paying semi-annual interest. If the coupon frequency is quarterly, you will be paying quarterly interest. If it's monthly, you will be paying monthly interest. I don't know. I think physical bond papers are hardly traded now. Everything is been dematerialized now. So you can obviously see bonds through various bond portals. That is something GA, you clearly jumped up to 3 stages ahead. So when I will directly jump onto premiums or discount, do you think other peers of yours will be able to understand it? I am going to definitely discuss that part as well. But hold on your thoughts for a while. I'm sure I'll going to discuss that. Sir, does the face value includes any interest, or it is the amount which investor invests? I am coming to that as well. Jumping to the example part, please carefully listen to the example and let me know if you are stuck anywhere. Let's say I bond, I bought a bond. Let's say I bought a bond. I am talking from investor's point of view. Let's say I bought a bond at 1000 rupees. Okay, not 1000 rupees. I bought a bond at 800 rupees. I bought a bond at 800 rupees with a coupon rate of 8% and with a coupon rate of 8% and face value of 1000. Time left to maturity is 3 years and the bond pays semi-annual coupons. Although it is irrelevant, but to give this a realistic view, the issuer of the bond is National Highway Authority of India. So NHAI, that the department who is associated in building highways, need funds and they have issued bonds. I, as an investor, has invested in those bonds. So read this and tell me if there is anything that you didn't understood as of now. Please read this carefully and let me know if you have not understood the structure of the bond. face value. Consider face value as face value only. Coupon rate at which bond is given is semi-annual. Semi-annual coupons. This bond pays semi-annual coupons, clearly mentioned over here. I will take on your doubts, but just give me a second. Let me calculate something. YTM of bond is, yield to maturity of bond is 7.58%. Okay, taking your questions one by one is for 800, but face value is for 1000. Coming to that, how he buy bond at 800, face value is 1000 because bond is being traded at a discount. Okay, I will come to that. What is discount, what is premium. Coupon rate which is given is semi-annual or which is annual or semi-annual. It is semi-annual. Face value is also bond value only. You can consider that the bond value of the face value of this bond is 1000, means something which is 1000 bought it for 800. You can consider it. Yes, you are in a right track to consider it. Sir, I am little bit confused about bond purchase rate and face value. Simply, I will be paying Reliance Industries 1800 rupees today, and Reliance Industries will be paying me 1000 rupees 300 years from now. What is to be confused in this? Please let me know. I am paying Reliance Industries 1800 today, and sorry, not Reliance Industries, but NHAI. NHAI is the issuer over here. So I will be paying NHAI 800 rupees today. And since NHAI has used that thing for the next 3 years, they will be paying me 1000 rupees after 3 years. That is clear. 8 semi-annual or 4:4. What does that mean? The rate that is given over here is always annual. If you wish to calculate the semi-annual amount, you need to divide it by the coupon frequency. So the rate that is been mentioned, this 7.58 is also annual. This 8% that is also annual. So always remember, guys, in bond sums, the rate every time mentioned in the question will always in the annual terms. It will not in the semi-annual terms or quarterly terms. It will always in the annual terms. Your voice is getting stuck. I think now it would be clear, would be paid. This means I will receive interest twice a year. Yes, you will be receiving interest 4% in first 6 months and 4% in the next 6 months. Okay. If it would have been quarterly bond, you would have divided 8% by 4. So you would have received 2% 4 times a year. Okay. So the total percent return is 8% because always interest rate is in annual terms. If you bought the bond, you bought the bond for 800 rupees. What is YTM, sir? How much? How much what? YTM is 7.58%. Now, simply look how the cash flows would work. Pay 100% of your attention and see how the cash flows would work from, again, investors' point of view. How the cash flow would work from investors' point of view. How YTM is 7.58%, I will also let you know. You will yourself calculate how YTM is 7.58%. You will be receiving 1000 rupees at the end. That is your face value. So look into the cash flows. This is time 0. YTM is yield to maturity. How it is calculated, that is something we have not covered yet. I am coming to that. Please hold on your thoughts for a while. I am coming to that. YTM. To make you understand that, I will have to plot the cash flows. Okay. Cash flows, T equals to 0. It means that today, Today, I have purchased this bond for 800 rupees. So this is a cash outflow for me. I have purchased this bond for 800 rupees. 6 months from now, I am going to receive my first coupon. 6 months from now, I am going to receive my first coupon, 12 months second coupon, 18 months third coupon, 24 months fourth coupon. Why? Because this is a semi-annual bond and I am receiving coupon every 6 months. 6 months, 12 months, 18 months, 24 months, 30 months, and 36 months, I am going to receive my last coupon. So what would be the amount of my first coupon? To get that amount, I am getting 8% coupon rate. I am getting 8% coupon rate. This 8% multiplied by 1000 is 80 rupees. So 80 rupees is my annual coupon rate. 80 rupees is my annual coupon rate. 80 rupees is my annual coupon rate. So in the first month, I have received 80 divided by 2. 80 was annual. Since I am receiving this twice in a year, 40 for this, 40 in 6 months and 40 in this next 6 months. So for first year, I have received 80. For second year, I have received 80. And for third year, I have received 80. Everyone clear with this? Everyone clear with this? Clear till here? Please let me know. Everyone clear till here? These are the coupon payments that I will receive. First coupon, second coupon, third coupon. Yes, coupon rate is always calculated on the face value. Mark a star mark on your notebook and make that star raised to infinity. This is how important it is. And note the point that coupon rate is always calculated on face value and never on the current price of the bond. SK, if you are receiving 8% coupon on 1000, what is 8% of 1000? This is different SK I am talking to, Subrata. I know you know this. Yes, SK, it is 80. But is this 80 annual or semi-annual? This 80, I always told you interest rate is always given on annual terms, right? So this 80 rupees is annual. It means that per annum you will be receiving 80 rupees. So what you will be receiving every 6 months? What is the amount that you will be receiving every 6 months? $49. 40, right? Everything will be computed on YTM. All these will be calculated on YTM GV. Hold on your thoughts for a while. Don't worry. The compounding factor will also be incorporated. Don't worry on this. So 40 rupees is received in first month, second month, third month. Sorry, in the first coupon, second coupon, third coupon, fourth coupon, fifth coupon, and sixth coupon. Correct? Every year we are receiving 80 rupees. Everyone clear till this? Everyone, are you guys clear till this part? Now, he might have invested on fixed deposit, but not on bonds. That is why so you are saying, telling about interest. That is why I was reluctant a bit to directly introduce interest as coupon. That is two different things, RT. I will come to that part as well, but still, please stay here with me till for that time period. In the sixth, after the sixth coupon, guys, please tell me one thing. We will be receiving coupon at the end of sixth month, 12th month, 18th month, 24th, 30th, and 36th. We will be receiving coupon after end of 6th month, 12th month, end of the period. Okay, so this is end of the period. Now everyone, when after paying 36th, after paying 6th coupon in 36th month, don't you think the bond will get matured in the next 3 years? This is 3 year, right? This was year 1, this is year 2, and this is 3rd year. Here the coupon will get matured, here the bond will get matured, and along with coupon, I will also get face value, that is 1000. Correct? I will also get face value, that is 1000. So what is my total cash flows for the period? 40, 40, 40, 40, 40, and 1040. Correct? 1040. 40, 40, 40, 40, 40, and 1040. So while calculating total cash flows, we will be calculating for every period, because there is also concept of time value of money involved, right? All of you are done with time value of money. For some of you, time value of money might have been covered by me. Some of you, for some other of you, time value of money might have been covered by Shilpi ma'am. Are all of you done with time value of money? Devjit, from which batch are you from? Devjit, which batch are you from? If not, no worries. If not, no worries. But those who are saying no, CB, SG, GV, please let me know which batch are you from. DK, which batch guys are you from? In basics of finance, she should have covered time value of money. Okay. Okay, don't worry, don't worry. If not, no worries. Done with Excel, right? You guys are done with Excel, right? So for IB0424, guys, are you done with Excel? Okay. Okay, got it, got it, got it, got it, got it. No worries, guys, no worries. No worries, no worries, no worries. Okay, okay, okay. These are my cash flows. 40, 40, 40, 40, 40, and 1040. Be right back on fixed income. I got it. Who are done with time value of money and who are not. I got, guys. It's perfect. No worries, no worries. Be right back, guys. Be right back on fixed income securities. This is 40, 40, 40, 40, 40, and 1040. Are you guys comfortable till here? Are you guys comfortable till here? Everyone? Everyone? Including the one who started their batch on 27th April or May? Everyone? Now, the question is, first coupon in 6 months is 40. Second, 12 months, 40. Third, 40. Fourth, 40. Fifth, 40. And sixth, 40. And what I paid is 800. I received 40, 40, 40, 40, 40, and 1040. Now I wish to calculate what is the return, what is the yield, not only return but yield that I generated. What is the yield that I generated? To get that, we will be using Excel. To get that, we will be using Excel. Okay, where in Excel we will be using rate function. In Excel we will be using the rate function. Everyone with me? In Excel we will be using rate function. And in rate function, when we will open rate function, so let me just share Excel with me. We will do this sum and then we will be ending our session for the day. When using over here, we will be using rate function is equals to rate, R-A-T-E, is equals to rate is what I will enter. Is TE rate is what I will enter. NPER, number of periods for which I have received coupon, 6. I have received 6 coupon payments in 3 years. So it would be 6. I have received coupon 6. PMT 40. PMT 40 because what is PMT? PMT is coupon rate, payment, coupon rate. PMT is used for coupon rate. PMT is 40. Present value is what I have paid today. I have paid 800 today. 800 going out of my pocket. So minus 800. Future value 1000. Type end of the period and I will close this bracket. That is 8.38. That is 8.38. This is basically the return that I generated, total return that I generated. This is basically the total return that I generated that we covered over here as YTM. So it's not 7.58, but 8.38. 8.38. This is my YTM. So this rate is my YTM. How is YTM calculated? Through financial calculator or yes, we have incorporated the semi-annual part, right? Where we have incorporated 40 rupees coupon. Okay, that rate that we got is semi-annual. Is that what you're saying? Just give me a second. Yeah, you're correct. So this rate that we got over here, 8.38 was for 6 months. This rate was for 6 months. So 8.38 into 2, we will get 16.75, approx 16.75, and that would be our YTM. So this was for 6 months, 8.38% into 2 is 16.75. That is your YTM. That is what the returns that you have generated. This YTM, someone asked me what is the formula for YTM. This YTM will be calculated using financial calculator or spreadsheet softwares like Excel. So that was it for the day, guys. That was it for the day. I know you might still be confused a bit on valuation part or calculation of YTM part, but don't worry, we are going to start from where we have left off. So yes, Priyanka. So how did we calculate? We used rate function. Is my Excel screen visible to you? is equal to rate function is what we used. Okay, Excel screen is not visible. Just give me a second. Now, is the screen visible? Now, is it visible, right? So is equals to rate function is what we will use. Number of periods is the period for which I have received the coupon. That is 6 coupon I have received. Number of period, PMT is 40 rupees I have received. PV is present value. It means that what I have paid as of today, it is minus 800. Why in minus? Because when we pay, there is a cash outflow. Cash outflow is represented in a negative sign. That is why minus 800. Future value is 1000. Yes, in N I have taken into 2 and in PMT I have divided it by 2. FV is FV is 1000, type is end of the period and bracket close. We are 8% over here and we multiplied when we this 8 by 2, we get 16.75. What we get is 16.75. You are not able to see the formula. Just give me a second. Now, is it any better? NPER, PMT, PV, 1000 and 0. So logically, if you see, this 6 represents the number of periods for which I have no need to multiply and do all those things. That was in another context 80. Don't get confused. Based on the logic that we have remembered, it's simply 6 payments I have received. 40 rupees is what I have received as payments. 800 rupees is what I paid for it. And 1000 rupees is what I will be getting. End means end of the period. This end comes for type. This 0 comes for type, which says end of the period, means after 6 months I will be receiving it. When you pay the bond, there itself you don't receive 40 rupees. You will have to wait for 6 months at least so that you can receive that payment of 40 rupees. That is why this has been taken as after 6 months, that is end of the period. If we are taking beginning of the period, we assume that right away when we pay for the bond, we are getting the payment principal amount or the coupon. But that is not usually the case. Why multiply by 2? Because number of periods that was left was 3. And to get number of coupons, since this is semi-annual bond, we have multiplied it by 2. This is 16. This is in annual terms. This is in annual terms, guys. This 17% is in annual terms. If we directly calculate, yeah, that would definitely not match. That would not match because you have not incorporated time value of money. Okay, SK. So logically, it's not about you won't get it like 1240 minus 800. That is 440 upon 800. That is not exactly what you are supposed to do. That it would give you 440 divided by 800 would give you 55%. This is overall divided by 3. This is 18.33%, which is wrong. This is wrong method to do it. It comes with the concept of time value of money and you have to incorporate that. Can we calculate as taking 8% and would consider it annually? No, you cannot assume all these things on your own. You cannot take any random number on your own and calculate on your own. It's just you need to go that over what is mentioned in the question. You have to follow that. We cannot just take our own assumptions. So yes, this was the Excel screen. And this was where we left off. Don't worry if you are not very much clear with this. Let me just share you the PDF. So Asit, if you have joined in November, probably you will be completed by next week. Probably. Fixed income securities. Yes, same. Yes, it will also be uploaded on LMS, don't worry. And if it is not uploaded on LMS by Tuesday, raise a ticket about it upload. 8% is not annual rate, 8% was semi-annual rate, and when it was converted to 16.75%, that was the annual rate of return. Yes, Devajit, please let me know if there is anything I can help you out with. So yes, please raise a ticket about it, Devajit. Please raise a ticket about it and I'll get in touch with you. We will see what are the different types of debt securities. Basically, what is the difference between bonds and debentures? Are debentures are issued by corporates, bonds are issued by government entities. That is the basic debentures. More or less, bonds and debentures can be used interchangeably. Bonds and debentures can be used interchangeably. So that's all, guys. That was all from my end. I hope you enjoyed the session. Waiting for your reviews. Hope to see you. Yes, rate is always annually. So that is why we have calculated in annual terms. Don't worry, PJ. I know it is a bit confusing part, but I will come to that tomorrow. We will be looking upon various aspects to it and we will be discussing that tomorrow. So RK, if you have not received it, Rohit, please raise a ticket about it. Okay, okay. I will explain that, SK. I will explain that in the next class. Don't worry. Okay, bye-bye. Have fun. Yes, we will be starting by Excel by next to next week, I guess. Let's see what happens. We will be starting with Excel by next to next week or probably by next starting from next month. So the if that is the feedback from your end, King, you can raise a ticket about it. That would be considered by management. Thank you, King. That is really a positive feedback, but you can raise that feedback to the management and you will be definitely be made aware about it. So bye bye, guys. Have fun. Thanks you. Thanks a lot. Bye bye.